Welcome to this explainer. Today, we're putting on our seasoned financial advisor hats and looking closely at how to actually manage wealth. We're going to peel back the layers of professional portfolio management to find the real secret sauce of long-term investing. Forget the daily stock market hype, right? Let's dive into the fundamental architecture of your wealth.
Here's our roadmap for today. First, we'll lay the foundation of investing. Then, we'll cover the three major allocation styles, followed by managing risk through rebalancing. After that, we'll see how these strategies survived historic market crashes, and finally, we'll wrap up with your personal investment profile.
Now, this quote right here completely shatters a very common investing myth. It reveals how distributing your money across different asset classes actually matters so much more than picking the next hot stock or trying to time the market. Believe it or not, it's literally the single biggest driver of your portfolio's return and risk.
Okay, moving into part one, the foundation of investing, specifically the building blocks.
Ask any pro advisor, and they'll tell you that different asset classes behave completely differently depending on what the economy is doing. It's kind of like having highly specific tools in your financial toolkit. You've got equities, which are your primary engine for long-term growth. Then you have bonds to provide that much-needed stability. Cash is there for your immediate liquidity, and gold, well, that acts as a really vital hedge against inflation. Let's jump to section 2, the three major allocation styles for managing your money. So here we see the fundamental difference between our first two styles. Strategic allocation is basically your long-term anchor. Think of it like a rigid 60-40 equity to bond split that you stick to through thick and thin no matter what. Tactical allocation, on the other hand, gives you room for short-term active adjustments. Say you expect interest rates to fall. A tactical approach lets you temporarily buy more bonds just to capitalize on that specific move. And then we have the third style, dynamic allocation. This one acts as a constantly shifting blueprint. Instead of holding on to those rigid targets, a dynamic strategy is always reacting to the current economic environment. For instance, if heavy recession fears start surfacing in the market, this strategy dictates immediately reducing equities and bumping up your cash and bond positions to protect your capital. It's totally fluid.
All right, on to section 3, managing risk through rebalancing.
Imagine you're starting your investment journey with a very standard discipline split. You've got 60% of your wealth in growth-driving equities and 40% anchored safely in stable bonds. This right here is your baseline risk level. But let's say a massive multi-year market rally happens. Your equity slice naturally swells in value, and suddenly it's making up 75% of your total pie. Now, while it feels awesome to see those gains, kind of like finding a $20 bill in your winter coat, you are quietly being exposed to a dangerous concentration risk. Without you doing anything, your portfolio is now significantly riskier than you originally intended. So to prevent this dangerous overexposure, the discipline of rebalancing steps in. It forces you to do what is psychologically super difficult. Sell your high-performing equities and use those profits to buy underperforming bonds. But by mechanically completing these steps, you take all the emotion out of it. You restore your original 60-40 target and securely lock in your preferred risk level. It's a total game changer. Let's move into section 4, historic crashes and surviving the worst. Looking back at the 2008 global financial crisis, we get a perfect real-time case study. Leading up to 2008, a ton of investors were highly concentrated in just equities, financial stocks, and real estate. And when the housing market collapsed, they suffered absolutely devastating portfolio-crushing losses. However, the investors who strictly maintained a balanced allocation, meaning they held government bonds, gold, and cash reserves, well, they experienced dramatically lower volatility and enjoyed a much faster path to recovery. Similarly, if we look at the global market collapse in March 2020, we see exactly why relying on one asset type is a massive recipe for disaster. Portfolios heavily weighted in travel and airline equities were completely decimated. But highly diversified portfolios that held gold, government bonds, and technology, they saw significantly smaller overall declines. So why did that happen? It's because these different assets have a low or even negative correlation to one another. Your portfolio survives unexpected economic shocks precisely because when one asset crashes, like hospitality stocks during the lockdowns, other assets react totally differently. Gold shot up due to massive market uncertainty, bonds benefited from investors seeking a safe haven, and tech stocks boomed thanks to the remote work trend. They literally balance each other out. Finally, we arrive at Section 5, Investment Profile and Your Unique Strategy.
The truth is, asset allocation is definitely not one size fits all. Your age, your income stability, your investment horizon, and of course, your risk tolerance, all of these dictate your unique target. A young professional with decades to go until retirement should confidently embrace aggressive equity growth, maybe an 80-20 split. Meanwhile, a retired investor who relies on their portfolio to literally pay the bills must prioritize capital preservation. They need to shift to a conservative mix that's heavy in the stable income of bonds and cash.
Ultimately, if there is only one major takeaway you get from the world of professional financial advisors, let it be this. Long-term investment success isn't about guessing the future. No way. It revolves entirely around balancing risk and return intelligently through deliberate asset allocation. So, based on everything we've unpacked today, it's time to take a hard look at your own accounts. Are you truly diversified across different asset classes with a strict rebalancing plan in place? Or are you highly concentrated, just waiting to be caught off guard by the next market crash? Something to think about.